Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the week ended Wednesday, September 27th, 2017. We actually saw about $10.4 billion enter the conventional fund business. This is the third week in four that we've actually seen net new money come in to the conventional fund business, but this was all in conservative assets, primarily into money market funds. I'll show you details later on. But basically, this is after we heard more and increased rhetoric from both the United States and North America, or North Korea. Talking North Korea talking about testing the A-bomb and bombing our bombers and the like, and I think that put people back a little bit. Although they seemed to blow that off, just a couple days after it happened. But also there was, I'm not going to say concern, but certainly an enlightenment by the Fed after the FOMC meeting for September, when they came out and they said, hey, listen, we are going to raise interest rates one more time this year, and we're also going to start unwinding that $4.5 trillion balance sheet in October. And so a lot of people said, hey, listen, maybe it's time to take some of our risk off our portfolios, get rid of some of those high flyers. Certainly we saw technology funds doing very well and technology issues doing very well over the last year-to-date time period. But a lot of folks actually started unwinding some of those positions and going into other asset classes. Let's call them underused and underappreciated assets out there. So we saw materials and the like actually gain some traction, which is good. We see a rotation in the market, and so we thought this rotation was probably in a timely fashion, timely manner, and maybe not a lot to talk about. And actually we got some very good news at the end of the week when we started seeing reports from the White House that they were going to revive and start pushing forward that sweeping reform tax package, which they actually put out on Tuesday and Wednesday, and it actually pushed the Russell 2000 to record highs, even though the Dow saw some loss, but we saw a record highs from the Russell 2000, and in fact it was the first time that we've seen that type of one-day move in the Russell 2000 since March, and certainly going to a record high, and we saw about a 2.34% return for the week Wednesday to Wednesday. So this was very strong news, but again, people remained somewhat dour when you take a look at flows. Let's take a look at the macro groups to see how that panned out. When we take a look, equity funds saw about $6.2 billion in outflows. And for this particular section, we're going to talk about just the conventional funds. We'll get into ETFs later on. When we take a look at taxable bond funds, they only saw about $126 million in net new money coming to that group. And muni bond funds was the high flyer for the group, doing about $283 million in net new money coming in. And then money market funds, as I said at the top of this piece, $16.1 million in net new money coming to that group. Well, let's see how these actually panned out in each of the individual groups so we can get a better flavor of what went on. Let's take a look at equity funds first. Equity funds were basically down about 0.11% as a group. First week in five that they actually seen losses, but for the 27th consecutive week, they've seen outflows, and this time to the tune of $6.2 billion. If we break that out, domestic equity funds saw the lion's shares we've been talking about over the last 37 months or so. $5.5 billion in outflows they had this week. And again, this was the 39th consecutive week that they've seen consecutive outflows. But on the flip side, they actually had plus a return, 0.38% return. Probably a lot to do with small caps and maybe even banking stocks after these threats or encouragement of interest rate increases over the next couple of weeks, months. And on the non-domestic side, we only saw about $686 million in outflows. And it's the second week in three we've seen outflows. But if we take a look at it, we basically saw non-domestic equity funds have a poorer return, minus 1.01% return. So it's still kind of a head scratcher why people are always focusing just on the international areas, although emerging markets, even European funds actually saw net inflows. And so even though we had the vote, the general elections in Germany and kind of mixed results for Merkel's CDU team, basically, I think people were feeling a little bit more comfortable, undervalued, and still seeking returns from international areas. And even though we saw slight outflows, it certainly wasn't the magnitude that we saw from the U.S. side. Now, if we take a look at it, large cap funds actually saw the largest outflows, about $4.1 billion, and international equity funds saw slight outflows as well, about $486 million as a whole. Well, let's take a look now at the ETF side of the arena and see what happened there. First week in 5, we saw outflows out of ETFs. So the authorized participants seem to be agreeing with the retail investor now. $3.5 billion in outflows. And how that actually occurred, we actually saw inflows for Spider Gold, again, conservative during the week. People kind of ducking for cover. So gold got a little jump there, about $768 million in net new money coming in that group. iShares NASDAQ Biotechnology ETF saw about $541 million in net new money coming to that. But on the downside, on the bottom side of this, we saw SPY, the Spider S&P 500, lose about $2.6 billion, and we saw the iShares Core S&P 500 lose about $2.1 billion. So those two accounted for all of those outflows that we were reporting earlier. Well, now let's take a look at our fixed income universe. And if we take a look at that for the second consecutive week, we saw inflows, but only to the tune of $126 million. In this first week in 5 that we've actually seen negative returns, 0.08%, but we still saw investors flock towards corporate investment grade debt funds, $630 million. And as the 7th consecutive week, they've padded the coffers of that group. And then international and global debt funds actually saw $293 million net new money come in. That's the 3rd consecutive week they've taken in money for that group. Flexible portfolio funds at the bottom of the group saw about $397 million in outflows. And then we saw corporate high yields actually lose money as well, $157 million. And if we take a look now at our ETF universe, we'll see a little bit of a flip there. Authorized participants seem to be a little bit more risk-seeking. They only took in about $326 million as a whole. That would be taxable bond fund ETFs. It's the 12th consecutive week they've taken in money. But at the top of the group, we saw the iShares iBox Dollar High Yield Corporate ETF basically taking $246 million, so not a lot, but still high yield nonetheless. And then the next one was a Spider Bloomberg Barclay High Yield ETF took in 242. So obviously the authorized participant was looking for higher yields and willing to put a little bit of risk on their taxable portion of their portfolio. At the bottom of the group, we saw the iShares 20-plus year Treasury bond ETF, basically losing about $437 million. Well, now to the bright spot of the group, and that is municipal debt funds. Municipal debt funds basically saw about $293 million. It's the 11th consecutive week they've taken in money, but it's the 3rd consecutive week that they've ever actually seen negative returns. This one, kind of a big one, 0.24% return. Not bad, but again, we're talking about a week's performance. But the big gainer actually was high yield muni bond funds. They took in about $142 million. Their 12th consecutive week of collecting new assets. Well, that brings us to the group that actually took in the most. As people ducked for cover, they actually ran for the money market funds. And money market funds for the 3rd week in 4 basically saw inflows of $16.1 billion. Taxable money market funds took in $16.4 billion, while tax-exempt money market funds handed about $278 million back. If we take a look at taxable money market funds, though, and we take a look at who was the big contributor to that, this time it turned out to be retail investors. Retail investors padded the coffers to about tune of about $11.7 billion, while the institutional end of the money market funds took in about $4.7 billion. Well, that's it for us this week. We did have some encouraging news over Thursday and early this morning, Friday. Basically, we saw that the second quarter GDP was revised up to 3.1%. I think that's encouraging news for the markets. And also, we saw that the average personal income rose about 0.2% in August. So these are all kind of strong indicators that the economy is still tooling along, and we'll see how investors weigh those positive news pieces along with the, if you will, increasing tensions that we see between North Korea and the United States and the like. Well, if I haven't given you kind of details that you need to get more information from, and you want to dig a little bit deeper, you can go to our site at www.lipperusfundflows.com, or you can join us next week where one of our analysts will talk to you about the flows trends for that week. Thanks for joining me. My name's Tom Roseen, wishing you the best in your wealth planning and creation.